Hi, I'm Paul Carroll. I'm the editor-in-chief at Insurance Thought Leadership. I'm delighted to be joined today by Matt Mosher, the CEO of AM Best. He moderated a panel at the Global Insurance Forum recently put on by the International Insurance Society on regulation in this rapidly changing environment we find ourselves in. And I wanted to pick his brain a little bit about what was said there and then continue the conversation. So again, I appreciate your taking the time.
Sure.
So to start off, technology is something that I've followed for a long time, going back to my days as a reporter at the Wall Street Journal, and have seen it play out in lots of ways. How do you see technology playing out in the regulatory environment these days?
Well, there's lots of different aspects to that. Obviously you have cyber insurance itself and how companies are dealing with that and those issues. But then you look at technology in the insurance business, and regulators now have to bring in a different type of expertise even to really fathom the level of data that's being used and used in the underwriting process or the claims process. And then also how underwriting is being done, period, in terms of the technology that's available to insurers, so that when they look at policies and they look at the process that insurers are using, regulators are challenged now to deal with that along with everything else that they're facing. And we talked about it on the panel, that the issue of ESG now they have to deal with, and then they have to deal with the standard aspects of affordability, availability, solvency, and bring on a whole new talent pool to deal with the issue of innovation and technology.
So to pursue that a bit, I found it really interesting a few years ago now when actually some of your folks at AM Best worked with some of my colleagues at Insurance Thought Leadership on an innovation component to your ratings. I mean, I've certainly seen the Kodaks of the world and Sears and written about some of them falling by the wayside because they didn't innovate fast enough, which is obviously something that in general we don't want to have happen in the insurance world, but what we also don't want to have happen because it can be so costly to individuals who are relying on the solvency of that insurance company. Could you talk a little bit about how that developed and how that's been playing out over the past few years, that innovation component?
Sure. And we started looking at this, and when you look at it and put it in perspective, the insurance industry has been innovating all through its history. The companies that are alive today and prospering today are doing so because they've innovated over the years. And what we looked at was, given the time frame that we're at with the social changes and the acceptance of technology and smartphones and everything that's out there, insurers were going to be pressured to innovate even faster, to be able to service their customers, to be able to provide the quality products and innovate in their own products, to handle claims, to do a better job of underwriting. Those are all things that insurers were going to have to innovate and improve their process to continue to maintain their position in the marketplace. And looking at the change in society, our view at that time was this is going to accelerate. And we believe it is accelerating. We continue to see more and more ideas coming in and changes in the insurance industry and what companies are doing. So we at that time we added the process of innovation and the assessment of innovation into our rating methodology. It's considered within our business profile area, which is kind of looking at an insurance company's market position, how they service their market, how they're viewed in the marketplace, and that's how they protect their earnings. If they have a strong business profile, and it'll be able to sustain themselves over time and protect their earnings, which is their future capital. So it plays an important role. It's one of the elements within business profile. It may improve or increase in its impact on the rating over time as we see the importance of innovation continue to evolve. But right now, it's one piece within the business profile aspect in how companies maintain their position in the marketplace. Innovation plays an important role in that.
It makes a lot of sense. So the elephant in the room for a while now has been the pandemic, and obviously that's changed a lot about how insurance companies have operated, and also about how regulators have had to operate. Um, any thoughts to share on how that's playing out, and maybe what long-term changes you see? I'm not convinced we're just going to snap back here in a few months to where we were 2 years ago, but you know a lot more about that than I do.
Yeah, I mean, absolutely. We're not gonna go back to where we were. Just this conversation we're having, the idea of Zoom, Teams, and the different approaches to that. It was there, but it wasn't something that was heavily used. We didn't heavily use it. Regulators didn't heavily use it. They were still visiting, sitting with companies in their offices all the time on every meeting that they were having, or having companies come to their offices. When we talked about it, there clearly is a shift in the ability of regulators to interact with the companies that they're dealing with. And we see it in our business as well. The interaction is very much virtual, saving time and being more efficient in that manner. It also plays into the role of having to deal with some of the rules and some of the aspects that regulators put out in terms of what their expectations are from companies and how they interact with them. What their expectation is from companies in interacting with claimants and the ability to interact. So they've been adjusting through that, I think, as everybody has, in utilizing technology that was there, but not utilized to its fullest extent, and not nearly where we are today.
Another one that has been coming up more and more is ESG. I worked on a book not too long ago with some senior partners at a consulting firm, and they actually say that those of us in the US, like me, I'm not saying you, have been a little naive about ESG, because it really began in Europe and other parts of the world and is now moving to the US. How do you see that playing out? That seems like a real additional pressure on insurance companies, but also on regulators, to make sure that there isn't just sort of a slavish devotion to metrics, but there's actually a commitment to the heart of what ESG is about, and a utilization of the idea.
Absolutely. It definitely is something that has emanated out of Europe, and we see it within our own organization here at AM Best, of how ESG, the drivers and those with the strongest knowledge are in our European offices. But you look at it from a regulator standpoint, and from the same way how we look at rating companies here at AM Best, a lot of what's in ESG are things that have been part of the process of regulating and analyzing an insurance company for years. ESG is an umbrella that covers a broad spectrum of things. But when you think of climate risk and how companies are dealing with climate risk, well, we've been looking at catastrophes and things of that nature, and regulators have been paying attention to that for years. Governance is something that's been extremely important, probably over the last 20 years, when ERM kicked in, and companies are looking very closely at governance and what's going on there. Over the past 5 years or so, you've had the insurance careers movement, and the whole issue of talent and attracting talent to the insurance industry, and how you retain talent in the insurance industry. Those are all the social aspects. Now, things have shifted with the pandemic, and things are shifting within society itself. So there's other aspects. Diversity and inclusion play an important role in terms of how companies are looked at these days. And regulators are looking at these things, of how companies are looking to sustain themselves in the long term. And when you look at ESG, again, there's all kinds of different elements in there, but every aspect of the element is about the long-term positioning and success of the insurance company and the sustainability of the insurance organization. So it makes sense that regulators would look at ESG. It does create an additional burden for them to look at a lot of the different elements, but again, they've been looking at governance. They've been looking at catastrophe risk and climate risk that's out there. Now they're looking at it in a little different focus, but it's still the same issues they've been looking at, but it creates a lot more work. Again, they have the basic work of availability, affordability, solvency, and now you throw on all this new technology. Now you throw on the idea that you're going to, as a regulator, you're going to be looking at how a company is implementing ESG. And what we see, you mentioned, and I mentioned as well, the idea that it started in Europe and is working its way into the US. What we see in talking to companies very often is when you throw out ESG generally, there's a little bit of a deer in the headlights look, or the thought of, well, that's about investments and how you manage your investments in green investments. But then you start talking to them about all the different issues, and they all of a sudden realize, wait, we're doing a lot of that stuff. We have a whole ESG strategy. We just don't think of it in terms of ESG in the big picture. We think of all the different components. And I think that's where the US is, where it's viewed as behind. It is behind Europe and where Europe is at, and the importance placed on sustainability and the issues of ESG. But it's further along than I think people realize when you unpackage it and look at the individual components that are focused on in the US market.
I agree. It's certainly about the deer in the headlights idea. I mean, it's sort of great. Now I have one more thing I have to deal with. I find it interesting. These folks I was working on the book with are working on a piece now for Harvard Business Review about how you can use ESG to play offense and not defense. So instead of just thinking about all the things you have to report, you can actually figure out a way to solve an ESG problem. So you figure out how to recycle batteries from electric vehicles and all that sort of thing. So I think it's a fertile area, and that gets me to the last thing that I wanted to really hit on. It's a nice segue because it does seem that there are lots of new risks out there. I mean, ESG isn't really a risk, but it's certainly something that companies have to think about. What new risks are you seeing, and how do you think regulators need to adapt to deal with, whether it's another pandemic, whether it's, as you say, climate change, whether it's some other sort of cyber risk or other new risk that's appearing these days?
Well, I think it varies by insurance industry. You look at the life industry, and some of the concern there is the investment aspects and the potential for trapped investments. And if you're not managing your investments properly, you could get caught where there's a lack of liquidity in that investment, and that could have an impact. On the property casualty side, you look at it from climate risk is certainly something that continues to play a role for companies. And what we're seeing is the escalation of climate risk and the severity that we're seeing come out of some of these storms because of the climate risk that's out there, and the potential change and the change we're seeing in various weather aspects. The one area that still is growing, it's still, I wouldn't say it's a huge risk when we look at it from a financial strength aspect, but the idea of reputation. And if you're not looking at these things, if you're not paying attention to some of these things, you can get left behind in terms of diversity and inclusion, and the aspect of training your people, how you treat your people. Think of it in terms of the pandemic. And now all of a sudden, we have lots of people working remotely, and they've worked remotely for a year or more. They're looking for something different from their company. So if you as an organization are not looking after your people, you may have a hard time keeping those people or attracting the people that you want to attract. So I would say in terms of the biggest risk that we're seeing for insurance companies is that aspect of how are you working through this process with your people and maintaining the talent pool that you need to run your organization overall. And that's something we talked about on the panel, is the biggest challenge that some of the regulators have is just the idea of attracting the talent into the regulatory bodies, and how do they keep that talent as well, and whether it be specific expertise such as technology, or is it just generally the insurance knowledge and what they have there. If they don't have that flexibility of the workforce and things that is expected now from many of the people in the industry, are they going to be able to attract and retain the talent that they have?
as sit here in Northern California, which has become sort of the wildfire capital of the world, I hear you when you're talking about new risks. I also think this is potentially an exciting time for the insurance industry. As somebody who chose to get involved in insurance 8 years ago, having spent a lot of time covering technology and then writing books on how to innovate, I'm always amazed at the people who talk about how they fell into insurance. Uh, and just, I mean, to me, this is an exciting industry. It's finally having a lot of new technology applied to it. And it seems to me that the opportunities for um, business success, but also for just doing good for an awful lot of people are enormous. So I don't mean to take the last word. Is there anything you want to say to summarize what we've said here today?
Well, I would just echo your point. Your last point you made is the insurance industry, I think, that still does a poor job in advertising the value it brings. The best chance an insurer has to advertise itself is when there's a claim. And the insurers struggle with that aspect and understanding that the value they bring is the protection they provide. And they can attract a lot of people if the people understood the good of the insurance industry. It's not just about writing a check for premium. It's all the protection that's there behind it. And the service that's provided from an insurance company, and the goodwill that they get out of the claims process is probably the best advertising they have. But the insurance industry needs to do a better job of advertising the good that it does for society.
I'd obviously encourage people to check out the International Insurance Society's Global Insurance Forum, where you can see not only the panel that Matt moderated with regulators from around the world, but a host of other really interesting sessions. As editor-in-chief at Insurance Thought Leadership, I'd obviously encourage you to check out what we're doing, in particular to sign up for the weekly free 6 Things newsletter that I do. And then, of course, check out what AM Best is up to. They put out an awful lot of very smart material. So go check that out. So thanks for taking the time.
Sure. Thank you, Paul.